Most people don't fail at investing because they pick bad stocks. They fail because they don't have a structure. They invest randomly. They chase headlines. They react emotionally. And eventually, they quit. So today, I'm going to show you a simple 3-layer investing strategy that removes emotion, reduces risk, and quietly builds real wealth. This isn't flashy, but it works. Before you try to grow money, you protect it. This layer is boring, and that's the point. It includes broad market index funds, retirement accounts like a 401k or Roth IRA, automatic monthly investing. Think of this as your financial engine. Instead of trying to beat the market, you become the market. Historically, the U.S. stock market has averaged around 8 to 10% annually over long periods. That doesn't feel exciting year to year. But over 20 plus years? It becomes powerful. Most wealthy investors didn't get rich from one stock. They got rich from consistent exposure. Layer 1 should make up about 70 to 80% of your investments. Why? Because stability compounds. Now we move to strategic growth. This is where you can allocate 10 to 20% of your portfolio toward individual high-quality stocks, sector ETFs like tech, AI, healthcare, real estate investment trusts, REITs. But here's the rule. You only invest in businesses you understand. If you can't explain how the company makes money in one sentence, you shouldn't own it. This layer adds upside without destroying your foundation. The mistake people make? They flip layer 1 and layer 2. They speculate heavily and stabilize lightly. That's backwards. This is the smallest layer, 5 to 10%. This is where higher risk, higher reward plays live. Startups, crypto, new technologies, emerging trends. But here's the mindset. You invest money you can emotionally afford to lose. Not rent money. Not emergency money. Not retirement money. This layer is optional. It adds excitement without threatening your financial future. Why this strategy works psychologically? Because it separates security from growth, from speculation. When everything is mixed together, emotions take over. When it's layered, you stay calm during market drops. You don't panic sell. You don't chase hype. You stay structured. And structure beats intensity. The real secret, automation. Here's where most people sabotage themselves. They try to time the market. Instead of timing the market, automate it. Set recurring investments. Invest every month. Ignore short-term noise. Market volatility punishes emotional investors. But it rewards disciplined ones. The long-term reality. Wealth doesn't explode. It stacks. Year after year. Layer after layer. And eventually, something happens. Your portfolio growth becomes larger than your monthly contribution. That's when investing shifts from effort to momentum. That's when money starts working harder than you. If you build your investing life in layers, you remove chaos. You remove guesswork. You remove fear. And what's left? Consistency. And consistency is what quietly builds wealth.